Hey everyone, ready for another deep dive. You know I love digging into this stuff, and you sent me a whole bunch of fascinating material on financial cycles and some of the big thinkers in the field. We've got like Ray Dalio, who's big on these debt cycles, Robert Shiller with that KPE ratio thing. It's going to be interesting to see how all these experts' ideas can maybe help us understand what's going on in the markets, maybe even make some smarter decisions with our money.
It's a really diverse group of experts. They
Yeah.
don't always agree with each other either, which I think makes it even more interesting, having those different perspectives.
Yeah, totally. Before we get into like the specifics of each expert, can you just give us like a quick overview of what we're talking about when we say financial cycles?
hmm
I mean, we all know economies kind of go up and down, but like what are the specific things that these experts are looking at?
Well, you can think of it like layers,
Mm.
like a cake. You've got the business cycle, like your basic, expansion, recession kind of thing. And then you've got credit cycles. Those are about like how easy or hard it is to borrow money. And then on top of that, you've got market cycles, the booms and busts that we see in like stocks, real estate, all that. And then finally, you have these long-term secular cycles that can play out over like decades.
Yeah.
And each expert kind of focuses on one or more of these layers.
Okay, so it's not just one big cycle, it's like a whole bunch of interconnected cycles. Kind of makes you wonder how anyone can predict anything in the markets.
Right. And that's where these experts come in, I guess. They
Yeah.
try to make sense of those patterns.
Okay, well, let's start with Ray Dalio, this hedge fund guy who's really into those debt cycles. He has this book, Principles for Navigating Big Debt Crises, and he talks about this economic machine model. What is that all about?
Well, Dalio's model is basically saying that debt is like the fuel. It drives the economic engine. When credit is cheap and easy to get, individuals and businesses, they borrow more, they invest more, the economy grows. It's kind of like a tide coming in, lifting all the boats up, but eventually the debt levels get too high, people can't keep borrowing and spending at the same rate, and the tide starts to go out. And that's when you get deleveraging, which can be really painful. Asset prices fall, the economy slows down.
So it's like a party that gets a little out of control. Everyone's having a good time, piling on the debt. But then the music stops and somebody's got to pay the piper.
Exactly. And Dalio's point is that these cycles, they've been playing out throughout history, from like the Roman Empire to the modern financial crises that we've seen.
Okay, that's a little bit sobering. But knowing about these cycles can maybe help us avoid getting caught in the, like, undertow, right?
Yeah, Dalio's work is all about understanding these patterns so we can see the risks coming and make better decisions about borrowing, investing, even just managing our own personal finances.
So Dalio is like the big picture macro guy. Now let's talk about Howard Marks. He seems to be more focused on the psychology of the markets. You mentioned he's big on like understanding how our emotions can mess us up when we're trying to make investment decisions.
Marx is really interesting. He combines this deep understanding of the markets with insights from behavioral psychology. He talks a lot about how, like, fear and greed drive the market cycles. When things are going well, people get really optimistic. They start piling into risky assets, pushing prices higher, you get a bubble. But when that bubble bursts, fear takes over and everybody's running for the exits, and that causes a crash.
It's like our emotions are actually shaping the market, like it's a self-fulfilling prophecy.
Yeah, that's exactly what Marx is saying. Successful investing isn't just about looking at numbers. It's also about understanding those psychological forces, learning how to control your own emotions.
So how do we do that? Do we all need to become like these emotionless robots?
Not exactly. Marx advocates for what he calls second-level thinking. It's about thinking differently from the crowd. Recognizing when emotions are driving the market and then making contrarian bets. That's how you find the real opportunities.
Okay, so we've got Dalio's macro perspective, Mark's focus on psychology. Let's talk about Robert Shiller, another Nobel Prize winner. He's famous for this thing called the KPE ratio. Can you explain that? What is it and why should we care?
The KP ratio stands for cyclically adjusted price-to-earnings ratio. It's basically Shiller's way of trying to measure whether the stock market is overvalued or undervalued, but over the long term. Unlike the regular PE ratio, which just looks at current earnings, the KPE ratio looks at 10 years' worth of earnings and adjusts them for inflation.
So it's like taking a longer, more level-headed view, not getting swept up in the hype.
Exactly. Shiller's point is that the regular PE ratio can be really misleading, especially when people are like super optimistic or super pessimistic. The KPE ratio tries to give you a more objective view of what a company's actually worth.
Okay, so if the KP ratio is high, it could be a sign that the market is like in a bubble. And if it's low, maybe it's a good time to buy.
That's the general idea. It's not a perfect tool or anything, but Schiller's research shows that it's actually been a pretty good predictor of long-term returns.
That's interesting. So we're starting to see a pattern here. These experts are all about recognizing patterns, whether it's debt cycles or market psychology or these long-term valuations. Next on the list is Hyman Minsky, and his work seems to be about how periods of stability can actually lead to instability. Kind of sounds like a paradox.
Yeah, Minsky's financial instability hypothesis is a really interesting concept. He basically says that when things are good for a long time, people get complacent, they start taking on more risk, lenders get less careful, and this leads to a buildup of debt and financial fragility, eventually setting the stage for a sudden crash. He calls those crashes Minsky moments.
So, like, what goes up must come down, but applied to how we handle risk when times are good.
Exactly. Minsky was saying that stability breeds instability. When things are good, we tend to get overconfident. We take on more risk than we can handle. And that leads to excessive leverage and then eventually a really painful correction. His work reminds us that even when things seem like they're going great, it's important to stay vigilant. Don't get carried away by the hype.
Well, these are some pretty thought-provoking ideas, and that's just the first few experts on our list. It's amazing how they all bring such different perspectives.
I know, right? And we've only just scratched the surface. There are so many more fascinating insights to uncover as we go through the rest of the material you sent.
You're right. We still got to talk about Martin Armstrong and that pi-based cycle model, Harry Dent's focus on demographics, George Soros and his idea of reflexivity, Benoit Mandelbrot, who brought fractal geometry into the mix, and even the legendary Paul Volcker's battle with stagflation in the 70s. This deep dive is just getting started. All right, so let's keep going with these financial cycle experts. Up next, we have Martin Armstrong. He's kind of known for a pretty unconventional approach. He uses this model based on pi, the mathematical constant, to predict economic trends. Sounds kind of like science fiction to me.
Armstrong's definitely unique, yeah. His economic confidence model is based on the idea that there are these fixed cycles that influence both economic and market trends. And these cycles, he says, that are about 8.6 years long. And they can be derived from mathematical relationships tied to pi.
So he's saying pi holds the key to like the whole financial universe. Pi is pretty cool and all, but that's a pretty bold claim.
Yeah. Armstrong's work is definitely controversial. Not everyone agrees with him. But he's made some pretty accurate predictions in the past, so people keep listening. It's a good reminder that sometimes you got to look at things from a totally different angle.
Yeah, sometimes you gotta think outside the box, even if it means looking at pi. Speaking of different perspectives, next up we have Harry Dent, who brings demographics into the picture. He says generational spending patterns drive those economic cycles.
Yeah. Dent's big on how those big demographic shifts, like the baby boomers entering retirement, they have a huge impact on everything. Consumer spending, housing prices, all of it. He calls it the demographic cliff. He predicts there's going to be a slowdown in economic growth as those boomers start spending less.
So basically he's saying our aging population is gonna put the brakes on the economy.
Yeah.
Not exactly music to the ears of anyone planning to retire soon.
Well, it's just a reminder that those long-term demographic trends, they're really powerful forces. Yeah. Investors and policymakers need to pay attention.
Makes sense. Demographics are a big deal. Okay, so let's move on to a name I think everyone knows, George Soros. Legendary investor who famously broke the Bank of England by shorting the British pound. But what's his unique take on these financial cycles?
Soros is known for his concept of reflexivity. It challenges this idea that markets are always rational and efficient. He believes that our biases, the perceptions of market participants, they actually influence the direction of the markets and create these feedback loops that can amplify those cycles.
So it's not just about the fundamentals, it's also about how we perceive those fundamentals. Our beliefs can become a self-fulfilling prophecy, driving both booms and busts.
That's exactly it. Soros is saying that markets are much more complex and less predictable than traditional economics models might suggest.
This is starting to feel like we're going down the rabbit hole, but I'm kind of loving it. Okay, next up, we've got Benoit Mandelbrot, the father of fractal geometry. Now, full disclosure, I'm not a math whiz. Can you break this down for me? How do fractals relate to the financial markets?
Okay, so imagine a coastline. From far away, it looks pretty smooth, right? But as you zoom in, you start to see all those jagged edges, the inlets, and bays. That's the basic idea behind fractals, repeating patterns at different scales. Mandelbrot applied that concept to markets, saying that price movements, they're not smooth and predictable like a lot of people think. They exhibit those fractal patterns with those sudden bursts of volatility.
So instead of a nice, gentle roller coaster ride, it's more like a wild ride with unexpected twists and turns.
That's a good way to put it. Mandelbrot challenged that traditional view of markets as following like a normal distribution. He argued that extreme events, those black swan events that people talk about, they're actually more common than we think.
Okay, well, that makes those market crashes a little less surprising, I guess, but also a bit scarier.
It definitely highlights the importance of risk management. You can't get lulled into this false sense of security just because things have been calm for a while.
All right, finally, let's talk about Paul Volcker, the former Fed chair. He's famous for taming inflation back in the 70s. How does his experience fit into all this talk about financial cycles?
Volcker's story is like a classic example of how policymakers try to manage those economic cycles,
Hmm.
sometimes wrestle with them. He was facing stagflation, high inflation, and slow growth, a really nasty combination. He took a very aggressive approach, raised interest rates significantly to try to get that inflation under control.
So he was willing to take some short-term pain to try to avoid a long-term economic disaster.
Yeah, it definitely caused a recession.
Hmm.
But it did break the back of inflation and set the stage for a period of stability. Volcker's actions show how important it is to understand those cyclical forces that are at play and be willing to make those tough decisions, even if they're not popular in the short term.
Wow, this is really making me rethink how I view the whole economy and the markets. It's not just random. There are these patterns and cycles and emotions all mixed up together.
It's fascinating, right? It's all about trying to understand those forces and use that knowledge to your advantage.
Yeah, and each expert we talked about, they all have their own unique way of looking at it. I'm starting to see the connections and the contradictions between their different approaches. This is really interesting. So what's the takeaway from all of this? How can we actually use this knowledge to make better decisions?
Okay, so we've explored a ton of ideas from these financial cycle experts, my head's spinning, but in a good way. So how do we tie it all together? What does this all mean for, like someone like me just trying to make sense of the financial world?
Yeah, it's been quite a journey. But, knowledge is only valuable if you can actually use it. So let's try to distill some actionable insights for you.
Sounds good to me.
Okay, so first off, the most important thing I think is just recognizing that cycles are like a fundamental part of the whole system, whether it's the economy, financial markets, credit, whatever. These patterns are always there, they're always playing out.
So it's not just random, like, chaos. There's some rhyme or reason to it all. Yeah, exactly. Yeah. And by understanding these patterns, what drives them, we can start to make more informed decisions.
Okay, so awareness is key, but how do we actually use that awareness, like, to our advantage?
Well, remember what Howard Marks said about market psychology.
Mm.
Fear and greed kind of driving those swings back and forth.
Yeah, it's like our emotions can become this self-fulfilling prophecy, right? Driving prices way up when we're all excited and then crashing them down when we panic.
Right, and that brings us to another important point. No two cycles are exactly alike. History can be a guide, but we need to be flexible. Adapt our strategies to the current situation.
Kind of like how Volcker had to take those drastic measures to fight that stagflation back in the 70s.
Yeah, exactly. And that leads to our next point, I think, the importance of having different perspectives, like all these experts we've been talking about, Dalio, Schiller, Minsky, they all bring something different to the table.
Right, there's no magic formula. It's more about having like a whole toolbox of different frameworks, and knowing which tool to use in each situation.
It's like having a map of the financial landscape with all those different routes and landmarks.
So how do we actually put this map to use? Can you give me like a concrete example of how knowing about these cycles can help me like make a better decision?
Sure. Let's say you're thinking about buying some stocks. Knowing where we are in the market cycle can be really important. If Schiller's key ratio is like flashing a warning sign, maybe you proceed with a bit more caution. Diversify your portfolio a bit more, or maybe even hold off on that big investment.
That makes sense. And on the other hand, if Dalio's debt cycle model is saying we're about to see a lot of deleveraging, maybe I should think twice about taking on more debt, or adjust my investment.
Exactly. It's about using these tools to make informed choices, not just blindly following the crowd.
Okay, yeah, this is all starting to make sense. Any final words of wisdom before we wrap up our deep dive?
Well, we've covered a lot of ground here, but it's important to remember, even the best models have their limitations. The real challenge is taking all this knowledge, applying some critical thinking, and then actually navigating this complex financial world that we live in.
So it's not about finding that one magic answer. It's about developing a deeper understanding. And then using that to make smarter choices.
I couldn't have said it better myself. The journey doesn't end here. Stay curious, keep learning, keep adapting as things change.
Great advice. Thanks for taking us on this journey. It's been a real eye-opener.
My pleasure. Always enjoy exploring these topics with curious minds like yours.
And to all our listeners out there, thanks for joining us on the deep dive. Keep exploring, keep questioning, and keep diving deeper.